Hey everyone, welcome back for another deep dive. Today we're going to be diving into the waters of corporate taxes.
Sure.
Specifically, this idea of converting from a C-Corp to an S-Corp.
Right.
Now, I know what you're thinking, taxes, exciting,
Yeah.
but stick with me because this deep dive could seriously save you some cash if you're a business owner.
Right.
We're unpacking an excerpt from the tax reduction letter, all about this conversion, and a little thing called the built-in gains tax.
Yeah,
Ever heard of it? It's not exactly a conversation starter, is it?
you're right. Not exactly cocktail party conversation.
Right.
But, it's something that every business owner considering this conversion, it's really something they need to understand.
Okay, so for those new to the world of corporate structures, let's
Yeah.
do a quick recap of the key differences between a C-Corp and an S-Corp
Sure.
in terms of how they're taxed.
Absolutely. With a C-Corp, you're essentially looking at double taxation. The corporation itself pays taxes on its profits. And then when those profits are distributed to shareholders, like yourself, you pay taxes on them again through your personal income tax.
Oh, so it's like hitting two toll booths on the same highway.
That's a great analogy. No, with an S-Corp, the profits and losses pass through directly to your personal income.
Right.
This means you're only taxed once at your individual income tax rate.
That's where the appeal comes in, right? Avoiding that double tax whammy. Our source material calls it a way to save thousands, and there's always a but with taxes.
Sure.
That's where this built-in gains tax or big comes in.
Exactly. And it can be a bit of a trapdoor if you're not careful.
Now, thinking about our listeners, I imagine some are realizing they might have these built-in gain assets without even knowing it.
Right.
What are some less obvious examples they should be aware of?
That's such a good point.
Yeah.
It's not always as obvious as, say, a piece of real estate that's skyrocketed in value.
Right.
It could be something like intangible assets, like goodwill. If your business has a strong brand reputation or even inventory, if you're in a business where inventory values tend to appreciate over time.
So it's like you've got this hidden potential tax liability just sitting on your balance sheet.
Right.
And if you trip over that trap door by converting to an S-Corp at the wrong time...
Yeah, then the IRS comes knocking,
Oh.
potentially looking to collect twice on those gains.
Okay, so let's break down exactly how this big tax works.
Okay.
Our source material uses the example of unpaid customer bills.
Right.
But I think it would be helpful to use a different scenario, something like appreciated equipment.
Great idea. Let's say you're a manufacturing company with a C-Corp structure.
Okay.
You own a specialized piece of equipment that you bought a few years ago for, say, $50,000.
Okay.
Now that equipment has appreciated in value and it's currently worth $100,000.
So you're sitting on a $50,000 gain, not bad.
Right.
But let's say you decide to convert to an S-Corp, hoping to take advantage of that single taxation.
This is where the built-in gains tax might come into play.
Okay.
Let's say a year after converting to an S-Corp, you sell that equipment for $100,000.
What happens then? Is it really double the taxes?
Well, not exactly double in the sense of the entire amount being taxed twice.
Okay.
But you will face that two-pronged hit we discussed.
Right.
First, the corporation itself is going to be taxed on that $50,000 gain at the corporate tax rate of 21%.
Ouch. So that's already a sizable chunk of that profit gone, but what about the rest?
That's where the second hit comes in because you're now an S-Corp. The remaining profit after that corporate tax is going to flow through to your personal income.
And since it's now considered personal income, it gets taxed again at my individual income tax rate.
Precisely. And those rates, as you know, can vary quite a bit depending on your income bracket,
Yeah.
potentially reaching up to 40.8%.
Okay, so we're talking about a potentially significant tax bite here, not just a nibble.
Yeah.
This is why understanding this big tax is so important.
Absolutely. And it's not just about the corporate tax rate. It's about understanding how that interplay with your personal income tax rate can impact your overall tax liability.
Right.
This is why careful planning and working with a tax professional are so crucial.
So it seems like timing is everything.
Yeah.
If you know you might sell appreciated assets soon, converting to an S-Corp right now might not be the best move, right?
Exactly. And that brings us to a critical point, the recognition period.
Okay.
This built-in gains tax doesn't hang over your head indefinitely.
Right.
It only applies to assets that were already appreciated at the time of conversion, and typically only for 5 years after the switch to an S-Corp.
So there's a statute of limitations on this tax hit.
Yeah.
That's somewhat reassuring.
Yeah. It's a crucial detail. Understanding this 5-year window can significantly impact your strategy.
Okay. I'm starting to see how this all ties into planning.
Right.
If you're strategic about the timing of your conversion,
Yeah.
you might be able to minimize or even completely avoid this built-in gains tax.
Precisely. It's not just about if you convert, but when.
Right.
Let's say you're that manufacturing business from our example.
Okay.
Instead of converting to an S-Corp right before selling that equipment, you might choose to wait a few years.
So that the equipment depreciates a bit, reducing the potential gain if you sell it after the 5-year window.
You got it. Or let's say you're a software company with a valuable customer list, a classic intangible asset that could trigger the big tax.
Okay.
You might decide to delay the conversion until you've had a chance to sign on enough new clients to offset those potential gains.
So it's all about thinking ahead,
Yeah.
understanding what assets might trigger this tax,
Right.
and timing your moves accordingly.
Exactly.
Yeah.
And as we touched upon earlier, bringing in a skilled tax professional is invaluable in this process.
Right.
They can look at your company's specific situation, analyze your asset portfolio, and help you develop a game plan that's tailored to your goals.
So instead of this big tax being a deal breaker,
Yeah.
it becomes more like a puzzle to solve.
I love that analogy. And like any good puzzle, having all the pieces is essential.
Right.
That's where meticulous record keeping comes in.
Okay, so we're talking spreadsheets, financial statements,
Right.
not just scribbled notes on cocktail napkins.
You're catching on. Having a clear picture of your assets basis, their current market value, depreciation schedules, it's all crucial for determining your potential built-in gains and making informed decisions.
This makes me think of a story I heard from a friend who's a financial advisor. He once had a client, a restaurant owner, who was gung-ho about converting to an S-Corp.
Right.
But when they dug into his financials, they realized he was sitting on a gold mine, literally.
Oh. Tell me more.
Turns out he had inherited a collection of rare wines years ago,
Wow.
and they had appreciated significantly in value.
Yeah?
He had completely forgotten about them, tucked away in his basement.
Oh, no.
But if he had converted to an S-Corp without considering those assets...
He could have been hit with a hefty big tax bill down the road.
Exactly. That's why this deep dive is so important. It's not just about understanding the rules of the game,
Right.
but also being aware of all the players on the field, your assets.
Couldn't agree more. It's about empowering yourself with the knowledge to make informed decisions.
Right.
Now, you mentioned that this restaurant owner wanted to convert to an S-Corp.
Yeah.
What are the advantages that make this conversion so attractive to business owners?
Right. So it's not like C-Corp are bad and S-Corp are good. It's about finding the structure that aligns, with your business's financial situation and goals.
Exactly. Going back to that double taxation we talked about with C-Corp.
Yeah.
While it might seem like a disadvantage, there are situations where it can actually be beneficial.
Okay, now that IS, interesting. How so?
Well, let's say your business is in a high growth phase.
Okay.
And you're reinvesting most, if not all, of your profits back into the company.
Okay.
With a C-Corp, you have the option of paying yourself a salary as an employee and then letting the remaining profits be taxed at the corporate rate.
Which historically has been lower than the top individual income tax rates.
Exactly. So in that scenario, the C-Corp structure could potentially lead to lower overall taxes.
Right.
Especially if you're strategic about salary levels.
It's all a balancing act, isn't it? Weighing the potential tax benefits against your business's current needs and long-term goals.
Precisely. And this circles back to the importance of consulting with a tax professional.
Right.
They can run those different scenarios, look at your specific numbers, and help you determine which structure is the most advantageous for you.
This has been such an eye-opening conversation.
It has.
We've covered a lot of ground, the ins and outs of C-Corp and S-Corp, that looming built-in gains tax, the importance of timing, record keeping, and of course, seeking professional advice.
Right.
But before we wrap up, I want to bring it back to our listeners one last time.
Okay.
Let's say someone listening to this is thinking, okay, this is all great information, but I'm feeling a little overwhelmed. Where do I even begin? What's one concrete action step they can take today to get the ball rolling?
That's a fantastic question, and it's one I hear often.
Right.
If I were advising a business owner in this position, I'd say start with this. Gather your financial documents.
Good old-fashioned organization to the rescue.
Exactly. But it doesn't have to be daunting.
Right.
Start by gathering your most recent business tax returns, financial statements, and any information about assets that have appreciated significantly in value.
Okay.
Even just taking that first step can give you a much clearer picture of where you stand and what questions to ask.
So it's about transforming that feeling of being overwhelmed into a sense of empowerment.
Right.
You're taking control of the information and using it to make informed decisions about your business's future.
Exactly. And once you have that information organized,
Yeah.
that's when you reach out to that trusted tax advisor we keep talking about.
Right.
They can help you navigate the complexities, strategize for the future, and hopefully save you some money along the way.
I love that. Because at the end of the day, that's what it's all about. Making smart financial decisions that allow your business to thrive. Absolutely.
Well, on that note, we'll wrap up this deep dive into the world of corporate taxes, built-in gains, and strategic conversions.
Okay.
We hope you found this episode insightful, empowering, and maybe even a little bit exciting. Remember, this isn't financial advice, so be sure to consult with a qualified professional before making any major decisions.
Right.
Until next time, happy strategizing.